Welcome to Market in a Minute. I don't know if you caught the Canadian and U.S. hockey match. Man, don't disrespect our national anthem. There's a big patriotic wave that's hitting our country. It's actually really fun to watch. The market index charts, they don't look very compelling. We've gone a long way and they're starting to go sideways. And I'll walk you through the valuations here quickly. We're bullish on what's happening at Doge. They're making some progress. It's going to take a while, but they're making progress. And we see a big peace dividend that may occur. The markets are going to like that. And then we're looking for fertile ground to hunt in. And we keep coming back to the emerging healthcare sector. It's still down quite a bit from its old highs. There's other sectors as well that we like a lot. So the stock market update. As we mentioned last week, we become a little bit more defensive. We put some hedges in the portfolio, not full hedge or anything like that, just enough to smooth out any sort of decline that we may have here in the short term. So we're cautiously bullish on the markets. So one thing to keep in mind is that the 10-year Treasury yield, roughly at 4.5%. You compare that to the PE of the stock market at 22 and a half times. The 10-year Treasury, if you do the inverse, gets you a 22 multiple. Now, generally, there's a risk premium involved, so you'd have to see the PE multiple, not 22 and a half, but lower. So maybe down at 20 times earnings to have really any value in the overall stock market. So that's what the market's struggling with. So until interest rates start to really fall, then the stock market is capped to the upside, but there's a lot of interesting stocks down below that. So on Doge, we think they have a very long way to go. They're coming up with some really interesting things, lots of wasteful spending, and I think they're really starting to cut to the bone with the Democrats. I don't know why the Democrats are so defensive about this, but the Republicans are kind of uncovering a lot of things that look very fraudulent actually. So that's kind of interesting to watch, but we think that this is a nice positive for the overall markets over time as that spending comes down. Now, the technicals of the market, I'll walk you through that in a second, but in general, we're at highs, and we've seen some great rotation in the other sectors of the market. The market's kind of playing out exactly as we thought so far this year. The tech stocks, the large cap tech stocks are lagging. There's a couple that we like there. One's not at the price we want to buy it really yet, which is Google. We like Google. And then Tesla, we think that's a trading buy at this point. But in general, the large cap technology stocks are not all that compelling. We think that this could be a really good year for stock picking. So as we get the rotation, the market broadens out, rates come down a little bit because inflation is subsiding. They'll pick up the other sectors of the market as well. So we like this environment quite a bit, how it's developing. Now the inflation is very key. So the inflation report last week, the CPI came in at 0.5. So if you annualize that, that's 6%. We think January is rather unusual in that you get the discounts in December because of the holiday, retailers discounting heavily, and that it impacts the January inflationary numbers. So really, we didn't see a lot of pickup in inflation in January. It's just that's how they calculate the numbers. So we'll see how that plays out. We think it's going to start to moderate down as we go over the next couple of months. And you can see here the overall inflation roughly at 3%. That's okay. It's not great, but it's okay. And we think that should moderate some. So as Doge cuts back, the government spending, inflation comes down. That's really bullish for the bond market. And so I think the stock market is anticipating this to occur. So it's at levels that probably is really too high given the current rate of the bond market. So if yields don't start to come down, it's going to be an issue for the stock market. In the meantime, we think we're kind of capped out here. But there is a nice probably peace dividend coming, and we'll walk through that as well. So the technicals of the market. So this is the S&P 500. We're back to the old highs. So we're back here again. It kind of, we were rolling over. We broke through that downtrend. That was a nice little opportunity to put some short-term money to work. And then we've come back to the old highs. And so we think it's just kind of tiring out. We think what's happening, if you look at the Magnificent Seven stocks, that they're starting to go sideways. I don't think the deep seek did any help to this overall group either. But this sector is going sideways. We thought this was a natural rotation to occur this year, and so that money is coming out of that sector. It looks like, and is going to other areas of the market. Where it's not going yet is the Russell 2000, but we think that the Russell 2000, it's just an index that is highly volatile. So coming down big doesn't really surprise us. It had a nice little correction here, and it's starting to work its way higher. We're going to keep an eye on that, but that's the area of the market that we want to focus on getting more invested in sometime this year as the fundamentals start to play out, as those interest rates start to come down and the economic growth for the private sector starts to pick up and the public part of the economy slows down with all these cuts occurring. So an asset allocation idea. So we've been on this for a while, right? So this is an area of the market we like. We like the emerging healthcare stocks. The XBI is the index that we look at. And if you look at this index over a long time, you'd say, wow, that's something I want to invest in. Those are just incredible returns over time, but they're extremely volatile. So you would not have want to wrote it down through here. I mean, this is really tough to ride this all the way down. And it got to a support level a couple times. You see the support level here. Got here a couple times where we were pounding the table, if you remember this, pounding the table on buying this. So we're up off the support level. We're trying to break out, just hasn't happened. We think the approach that investors should take is don't buy the index. I mean, there's crap in there you don't want to own. You want to focus on the best companies, and that's what I do. We focus on the best companies. So we find really good potential products that are being developed with financing in place and good management and buying them at the right time. So we're going to walk through Grail here in a second, and this is a good case study of what we do. So over a 3-year period, we think that as the index itself goes back to that old high, there's an 88% return to go back to the old high. Now, if we're good at picking the right stocks, we can probably outperform that considerably. So maybe it takes 5 years, but somewhere between that 3 and 5 year period. So you have to have somewhat of a time horizon. We think the index lifts, and we think the better companies lift a lot more. So we mentioned Grail. We mentioned Grail over and over again on our updates. When it first came out, this was June of 2024. This is a company that we liked that Illumina bought. It was private. They bought them. They created this blood detection of over 50 cancers. It's machine learning rather than artificial intelligence. It's machine learning, and it picks up the DNA in your blood of the cancer early so it can be treated. I think it's just a wonderful technology, and it's been talked about here recently. That's why the stock's gone up so much. So you can see this is back when it came out. You can see it for roughly $12, $13 in this massive move. It got on Monday, for a very brief moment, it ticked over 60. So I think in the short term, it got way overdone. But we think that there's considerable more upside. So we think this is in the early stages of a big move, much more than what it's had. However, it's a big move already. So it's gone from 500 billion market cap, 500 million market cap to almost 2 billion market cap in roughly 8 months. So 13 to 55 plus over an 8-month period. So what we did in our healthcare strategies, the stock got way overweighted. So it got to roughly 26% of the strategy. So we pared it back. Still a very meaningful position. It's still 10% of the strategy. We still like a lot, but we felt compelled to pare it back. So in the short term, barring any acquisition, we think it's going to go up at a little slower pace. But still like this company a lot, and this is the exact type of company that we like to buy in our emerging healthcare strategy. The peace dividend. So the axis of evil seems to be falling apart. So Russia has to come to a deal. So their economy is falling apart. Interest rates are really high in Russia. Inflation is very high. They don't have people to hire because half of a million people died. So they have to do something to save face. And if Putin doesn't save face and loses the war, which I think Trump's willing to give the Ukrainians the okay on long-range missiles, and then also cut off any Russian exports of oil, that'll put Russia out of business and Putin will no longer be. So we think Russia is going to come to the table and come up with an agreement. And then that agreement will be ratified by the Ukrainians. They have no choice. And also the Ukrainians will have to get some sort of recognition as well for being involved in this. So the cannon will turn from Russia, Ukraine, to Iran. So you can see it happening already. I'm surprised it hasn't happened sooner, really, but Iran will be in focus. Iran will either be, the leadership there will be gone, or an agreement will come in place, and that'll put Iran on their heels. And then it goes to North Korea. We don't see them really as a player, and at least China. And then China has similar problems as Russia, not as bad, but similar problems. They need to fix their economy. So with Trump in office, they're not going to start any sort of aggressive takeover of Taiwan. So they are back to fixing their economy. I think the market's sensing all this. You can see the stocks in Europe starting to appreciate some, and then also in China starting to act better. So we think that there's a big peace dividend coming. We see Doge making their way over the Pentagon. We think that they're going to find a lot of stupid spending there, if not fraudulent spending, but a lot of just mismanagement of their budget. And so we see that spending maybe shrinking or being spent on smarter things, maybe to increase our defensive in the Asia Pacific region. So this big dividend is coming, a peace dividend for the world to spend their money on things that are smarter. So this will have an impact on probably valuations a little bit. So instead of being completely defensive at this point, because we're not rolling over yet, we do see this peace dividend. We do see Doge cutting back a lot of spending. So we are very cautiously being bullish. And the market's not going to go in a straight line this year. It's going to struggle, and there's going to be a lot of really interesting stocks to buy. So to wrap this up, if you like what we do in the emerging healthcare, give us a call. We're happy to explain in more detail what we do. And there's a lot of really interesting stocks to buy in that area. And then there's other sectors of the market that we're focused on that are undervalued, and the fundamentals are just in the really early stages of starting to get better. So if you have any questions, just ping me. Come to my website, Patrick Adams CFA. Sign up for a hard copy of Market in a Minute, and we'll send that to you every week. Take care.